In this presentation, we will enter the loan payments, breaking out the interest and principal portion of the loan payments with the use of an amortization table within QuickBooks. For more accounting information and accounting courses, visit our website at accountinginstruction.info. We will now use our amortization table to record these transactions again, these two questions in the more complex type of format, in that we're going to record the same $50,000 loan that we had. That won't change if the loan was made in the way it was. We just got cash for the loan. The second piece, however, being that amount that was paid on the loan, we will now record in accordance with the amortization table that we just made. So now we're going to make this amortization table and break out the interest and principal portions. To do this, we'll open up the QuickBooks file. We're going to go into our folder here. We're going to open up the QuickBooks file. We want a QuickBooks data file. We're going to go to the more complex one this time in QuickBooks 3. So we're going to open up the third data file. You could find a backup file that should get us to the same point as well. Going to open up the more complex QuickBooks file so that we can do the more complex method within it. We currently have the home page open. We have the open windows open. You can open the open windows by selecting the view dropdown and going to the open windows list. We'll now take a look at our reports. We're going to go to the reports dropdown. We're going to go to the company and financial. We're going to go down to the balance sheet standard. Once again, balance sheet standard. We're going to change those dates, that date range up top in the customized reports from 01/01/19 to 02/28/19. So January 1st, 2019 to the end of February 28th, 2019, and okay. What we're looking for first will be this loan payment that we had. So we're looking for the $50,000 loan payment that we put into the checking account. So we have it here. Now, this one's a little bit different because we already have a loan, because this was a different loan down here, a loan payable that we had when we financed the equipment. And then we had this other loan that we had that we put on the books when we started the company, when we took out a cash loan. This loan down here, loan payable, wasn't in our simplified file because we recorded the equipment at cash paid and are planning on the accountant to put on the books the actual loan amount. Here we're going to still reallocate, as we did in the simple method, the loan payment that was made. So if we double click on the checking account, or the loan that was taken out, if we double click on the checking account, we go down and we see this $50,000 loan. There it is there. Let's take a look at it on the profit and loss as well. Closing this out, we did this same activity in the prior example. The difference here, however, will be that we have an option of combining this loan or breaking out the loan with this other loan. So we'll see that option in a second. We'll go to the reports dropdown again, go to company and financial. We're going to choose the profit and loss standard. Changing the date range from 01/01/19 to 02/28/19. Here is our information. We're going to go to this uncategorized income. Uncategorized income, double clicking on that item, we see the $50,000 in the deposit amount here. So we're going to double click on that $50,000, and then we want to categorize it now to the loan payable. Now here's where our options are. If I click the drop down, we now have a liability account called loans payable. Now if we think about that, if we go back to the balance sheet and look at that loans payable, back to the balance sheet in the open windows, this loan payable is another loan from the equipment account that we put on the books when we financed the equipment. The question now is, as the bookkeeper, do we want to have one loan account where we put multiple loans, or do we want to have multiple accounts that will record the loans separately? And either method can work, and there's pros and cons to either method. If we have multiple loans in our account in QuickBooks, then it's kind of easier for us to see the breakout between the two different loans, and we can put different loan numbers on them to track them. However, it also adds a level of confusion to the financial statements, and if we give the financial statements to others, then they might be confused by the multiple loan accounts. So there's a couple different options we can use for that. So just be aware that if you're working with a company that has a lot of loans, hopefully not the case if it's a small bookkeeping company, but many companies actually could have a lot of loans, especially if they're dealing with like purchasing of equipment and whatnot. Then you want to be more careful to break out those loans. Either method, if we're tracking the loan balances, as we'll do in this more complex method, we're going to want something outside of QuickBooks as well, such as the amortization table, to track the loans. So just be aware of that. We're just going to put the loan to the same loan payable here and track the information given the amortization tables outside of this. So we'll have supporting documentation under this method for this information. And note again, this is the more complex method. In a simplified method, the backup documentation would hopefully be given to the accountant at the end of the year to do the adjusting entries and or create the tax returns from them. Okay, so let's go back to the deposit here. We're going to go back to the deposit, and we're just going to change this undeposited amount, and we're going to put it into that loan payable. So here's loan payable. We're going to select that item. I'm going to change that deposit and put it into loan payable, save and close. So we'll say yes, okay, and now we've moved it out of there. So if we go to the transaction detail, it's no longer there. That 50,000 is gone. Closing that out, go back to the profit and loss. We can see the 50,000 is gone out of uncategorized income. Where did it go? It went to the balance sheet, going to the open windows. A lot of open windows going back and forth here. The balance sheet now has the 56,000 in loan payable. Double clicking on that, we have the 6,000 from the prior transaction when we financed the equipment, 50,000 now. So there's the first component, very similar, this transfer at least, as our simplified method that we would have. The difference now is that we're going to record the payment in accordance with our amortization table. So here's the table. We're recording this first payment now. I'm going to just highlight that. And it's going to be a little bit more complex that we'll have to deal with. This is the amount of payment that we had. So if we go find that payment, we could say, where is that payment? Closing this back out. It's under the checking account. We had a payment down here. It was on in February to the bank. So here it is, $944. We can also find it on the profit and loss, closing this back out, which is probably easier, to the profit and loss in the open windows. In uncategorized expenses, because that's where we put it, just as a holding account, so we found out where it should go. Double clicking on that, we see that we had the bank here for the 944. There it is. So we're just going to double click on this and change it now. We're going to double click on it, and we're going to change the uncategorized account to some type of account. Now, the account that it should go to is going to go to two accounts now, because this amount, back to our table here, this is the amount of principal and this is the amount of interest. And this is what the balance should be after that breakout. So let's do that. We're going to say the loan should go down by the 735. So let's break that out. We're going to say loan payable up top is going to be this item, loan payable. Problem, it appears you're about to pay your payroll liabilities. Not payroll liabilities, the loan payable. And it's going to be for the amount of the 735. So 735. Now the difference then, it's going to give us that difference because it's trying to be in balance. It's saying, hey, you decreased the checking account by this amount. You only allocated to another account this amount. The difference is 209. And that then is going to be, and it's rounding because this has actually got pennies involved in it. So we won't deal with the pennies, meaning there's cents here. If I was to add decimals, it's actually, there's the dollars and change. But we're going to do the rounding here and just use whole numbers. So the difference then is going to be that 209. That's going to be the interest expense. Let's see if QuickBooks generated an interest expense account. See all the expenses here. Do we have an interest expense? We do. It made an interest expense for us. And most of the accounts that QuickBooks will make, most industry accounts, chart of accounts, they will give you an interest expense. So we're going to say interest expense, that's where it's going to go. That's the difference. So we have three accounts that are affected here: cash, loan payable, interest expense. Let's record it, see what happens. Save and close. Yes. Now it's removed from the transaction detail by account, which is good. That's what we want. Closing this back out, we see that it's no longer an uncategorized. We should see an interest expense in here. There it is, interest expense. So now it does affect the income statement, but only the interest portion should affect the income statement, not the entire payment amount. So there's the interest portion. If we go to the balance sheet, then the other side of this is going to be in the loan payable. Obviously, the checking account's still going down. Loan payable, double-clicking that, we see the amount here of $735. Now, if we look at the difference here, the amount of this loan, the $50,000 minus the $735, $49,265 of this $55,265 is due to this loan. The other loan is that $6,000 amount. So if we go to our balance here, we see that should be our loan balance, $49,265, $49,265. And so that's how this table should work. We should be able to, after we allocate properly, we should have the new principal should always line up. And that's why it is useful sometimes if you have a lot of loans to have a different loan per line and per account. And if you do have a different account, it's useful to set it up as basically the loan name and then maybe the last 4 digits of the loan number to differentiate the different loans. If you want to have a loan payable 1 and then the account number. Or you can put it into the same account. You just got to then do a little bit more work to know what the loan balance is. And hopefully, again, for small clients, we won't have a whole lot of different loans out, and that won't be a problem. For more accounting information and accounting courses, visit our website at accountinginstruction.info.